All right, guys, let's go ahead and get started. Welcome everybody to our webinar today on cost segregation and how to get huge tax breaks on your real estate. We have our, my name is Brad 𝐁𝐨�𝐵, and my associate business partner, Jay Peterson, is here. And we have our guest speaker today, Bonnie Kaake with Cost Segregation Services, Inc. Before we get started with Bonnie on her presentation, I just wanted to give you a little bit of background on what we do. Westpeak Properties, we are here to help you create cash flow and build wealth through investing in real estate. We are a full service brokerage company specializing in investment properties ranging from a single family home to a 15, 20 unit apartment building. We have been doing this a very long time. We're very good at what we do, if I want to brag. We've been around since 2009. We have over 40 years of combined experience. We can help you find it, analyze it, buy it, manage it, flip it, 1031 exchange it, figure out how to save on your taxes with it, etc. So we also do some of our own investing, own some of our own properties. We have an extensive network of investors, and about 20% of our transactions every year are transacted off market. So always a good idea to reach out to us if you have something you're looking to buy or sell, and see if we can put you in touch with either a buyer or a seller. We don't do property management ourselves, but we do work with experienced property management partners, and we are very happy to put you in touch with the folks that we've vetted out if you have a property management need. We do these webinars probably every 2 to 3 months throughout the year. Our next webinar will be on estate planning for real estate investors. And you can check out our past webinars on the education tab of our website, westpeakproperties.com. We've got webinars on there on various topics ranging from Section 8 rentals, tax law, best property management best practices, 1031 exchanges, etc. We're also in the process of implementing a YouTube channel, and so look for some marketing on that so you can go to our YouTube channel for these types of educational webinars. This is how to get a hold of us. Again, I'm Brad 𝐁𝐁𝐵, Jay Peterson, and we have our associate broker, Charlie Middlehouse. Phone numbers and email addresses here. Today's guest speaker is Bonnie Kaake with Cost Segregation Services, Inc. She is a national account executive with them. Been doing this a long time, does a lot of speaking, so we're very happy to have her here. She's very good at what she does as well. CSSI is the nation's oldest and largest engineering-based cost segregation firm. And Bonnie is going to explain what engineering-based cost segregation is and how you can use that to save big on your tax bill. So Bonnie, I'll let you take it from here and further introduce yourself and go from there.
Okay. Let's do this. Thank you very much, Brad and Jay, for inviting me and allowing me to present to your group of investors here. I'm here to help them understand that cash flow is king, and I can help them make that happen with understanding more of the time value of money and how cost segregation can help. So let's see here.
I was just going to interject. If there's any questions during Bonnie's presentation, I will kind of raise the hand and alert Bonnie. So feel free to ask questions as we go.
Okay, please do. I've been with cost segregation services for over 4 years. I do classes for CPAs on how to leverage this for their clients. I am not only a real estate broker licensed, but my license is inactive. I don't compete with my associates, but I've owned commercial property as an investor and an owner. You can always look at my LinkedIn profile here on the, that I show here. CSSI has been around a long time. We've completed over 30,000 studies in all 50 states. So it doesn't matter whether you have a $200,000 property or 2.5 billion with a B, we can handle it regardless of the complexity. Our CEO has been involved with cost seg since the original court case. That was in 1997. And we complete our studies in 6 to 8 weeks. We're working on getting that shorter. We are the calculation resource for your tax professional and to keep you and your tax professional compliant. Today's presentation, I'm going to go over 3 of these 4. The last one on here, the CARES Act, ends with the 2020 tax filing, so it's not as relevant as it was earlier in the year. But cost segregation, tangible property regulations, and Tax Cuts and Jobs Act are all very relevant for your investing purposes. Cost segregation is accelerating the depreciation, and right now we can do it 100% in the very first year we do a cost segregation on your property. Whether you've owned that property for 1 month or you've owned it for 20 years, we can help you with that. It's like getting a free loan from the IRS that when you pay it back, you don't even have to pay all of it back. And I'll talk a little more about that. And again, if you have questions, please put them in the chat box. But usually it allows you to use the cash today, because we know cash flow is king, instead of leaving it with the government for 27 and a half or 39 years. Engineering based is the best study you can do. It's the IRS preferred methodology, and you don't have to worry about getting audited because we stand behind it at no cost to you when we do a study. Basically, cost segregation is separating the personal property from the tangible property. Actually, it's the structure of the building versus the tangible property in the building, which can be taken up front in accelerated depreciation. So cost segregation, if you explain it in very simple terms, it's like a hamburger. You pay $3.99 for a hamburger, it's that whole hamburger or your whole building. With a cost segregation method, we're going to break out those patties, which might equate to the structure of your property, and the sauce, lettuce, cheese, pickles, onions on a Sesame Street bun, if you remember that jingle. The other items we can segregate out, and you get to depreciate those right up front. So items that can be accelerated. These are 5- and 7-year property items that can be pulled out up front. The interior doors, partitions, special electrical and plumbing, carpeting, decorative molding. A lot of these things can be taken up front. Even doors and sometimes windows can be taken up front. Okay. So items that can be accelerated also are 15-year property items. Things like landscaping, paving, parking lots, sidewalks, irrigation. There are a lot of things that a lot of CPAs and tax professionals don't think about because they're not engineers. They're not experts in construction. They aren't expected to be. That's where we come in. We can do that for them, give them the detailed computations they need to file your taxes. And if you look at this chart here on the right, you'll see that this is what happens with high performance accelerated depreciation, cost segregation. You get that cash flow up front, and then you have less to depreciate over the following years, but you have that cash flow now. All right, why is this not changing? Here we go. Also with our cost segregation work, you're going to get breakdowns for the building components, the site work, and the building structure. This is good for your CPA later on, because if you're doing some changes on the more, the 1250 property, which is your roofing systems and HVAC, what we can do is look at this in more depth, because a lot of times the HVAC, they will automatically put that into a capitalized item and try depreciating that over 27 and a half or 39 years. And in reality, a lot of the work that's done on the HVAC system is not replacing the entire system, it's a repair. And on those, we can take those and take a look at it and actually depreciate that right up front.
Now, Bonnie, let me ask you a question on that. So
Sure,
that has to do with the amount of money spent, right?
That's right.
As a percentage of the total cost of that. Can
yes. Yes.
help me understand that a little better.
Okay, it's if you're replacing an entire HVAC system, and let's say you have 3 of those on a building,
Sure.
If you're replacing one of those and you're not making it more than 25% improved than the efficiency or what you're doing on the first one that you're taking out, then you can actually expense that item. But a lot of times, you know,
So let's say, I'm sorry, let me slow it.
okay.
Right now. So if I've got 3 HVACs, if I'm doing a rehab on a property and I'm doing 3 HVAC systems on this property, if I did all 3 of them at once, I'd probably have to capitalize that.
Yes, if you're replacing the entire
if I did one at a time, I could expense it potentially.
potentially, yes.
Because the total cost of what I'm doing is less than a certain threshold, right? So it's semantics, and you know all the numbers. I don't, but there's ways that you can massage the various components and get bigger tax breaks, is what you're saying, right?
Yes, and the ideal thing is to talk to me before you decide to do some of this stuff, because I can help you figure out how to create the invoices such that you can actually expense more of it rather than take it all as capitalized.
Sure.
A typical thing is the roofing systems. Rarely do you replace the entire roof down to the rafters. Usually it's the shingles or it's the underlayment that's being replaced. And that, in a lot of times, can be expensed. And if you separate the labor from the actual what's being done, there's more opportunity even there for being able to expense some items. So this is what you were talking about a little earlier, and Brad, where you were saying, okay, replacement value here. We're going to give you the depreciable cost currently, and then the current replacement cost. And in a lot of situations, if you're replacing, you know, part of this, then if it's less than 30% of the number on the right, it can be expensed. So this really helps your CPA going forward. But again, we want to talk before you go ahead with it, because a lot of times what you're doing is you're replacing part of it, not all of it.
So if I bought a property and I'm interested in rehabbing that property, I would want to do a cost seg up front.
Yes, you do a cost seg up front, and then let us know what it is you're going to be doing. Because another thing I'm going to cover here is what's called partial asset disposition.
Right.
That comes under the tangible property regulations, which are very complex. So what I can help you understand when you're going to do this renovation is being able to expense what you're taking out of the building as well.
Oh, wow. Okay.
Okay. But if you don't do that the first year, you lose the opportunity to do that.
Okay. Jay, we have a question.
We do. Yep. So Elston asks, so if I did a rehab last year and did not do this for each piece of equipment in HVAC, is it too late?
The partial asset disposition has to be done in the year that it's done. Now, if he did it in 2020, he may be able to still put through an amendment on his taxes for 2020, but that's a discussion to have with your tax professional. Now, cost segregation you can still do.
Yeah. So there's a distinction between those two. You could still do the cost seg and get some accelerated depreciation on what he did, but he didn't do the study up front to try to get like the full expensing of things before he did that. Right. A little bit of a nuance, but
just a little nuance.
Yeah.
But this is a typical example here of the advantage of doing this. You know, here's a residential rental condo. The building cost without land, of course, there's not much land with a condo, but $198,000. So the tax savings, taxes he does not have to pay is $60,800. So the study fee, our study fee before tax is $2,730. But because our fees are tax deductible for you, it's an expense, then the actual study fee comes down to $1,720. The ROI on here, 35 to 1. I mean, who wouldn't want 35 to 1 on getting, you know, this kind of a benefit?
Right.
Now, I want to jump over here to the rental house in Steamboat Springs. On rental properties in vacation areas, a lot of times the land is very high, and therefore we can't depreciate land. So we can only depreciate the building. So therefore, also this client's tax rate was 20%. So the lower your tax rate, it's going to make a difference as well. So this particular client only got a 7 to 1 ROI, but still went forward. And when we found out that the land value is high, this also happens in the Denver metro area, downtown in particular, where the land values are getting crazy. We also do commercial properties, larger dental offices, office condos, warehouses. And a lot of people will tell me, gee, my CPA has already done this. Well, a CPA can pick a few things and accelerate the depreciation on them, but they barely scratch the surface. As you can see here, the increased cash savings by doing an engineering-based cost seg study, the difference is $42,000 after tax. So you don't want to leave that money on the table, and it doesn't cost you anything to get an estimate on it. So, and there's nothing risky about this. The American Institute of CPAs is telling all their CPAs, anything that's $750,000 or more, you really need to do this because it's an advantage to your client. But a lot of CPAs and tax pros will hesitate to even tell you about it. It's easier to do straight line depreciation for them. Some of them are afraid of doing 3115s, which are change of accounting forms. Don't worry about it. Give me a call, I'll give you an estimate, and then we'll go back, and if they have questions, I can answer them or get answers for them. Journal of Accountancy also.
Jay, we had
There's
another question.
no
Hold on,
risk.
yeah, we have another one here. Ryan says, can you help me understand the value proposition in using CSSI versus doing it myself, in meaning the DIY options online for $500? I know you pay what you get for, just trying to fully understand the value of what you offer.
Well, if you get audited, you're on very, very shaky grounds. Those $500 estimates may be good for something that's less than $200,000 at purchase price. They're not going to question it much. But if you start getting into larger properties, it's kind of a red flag for the IRS. So you'd be better off doing an engineering-based method where we're looking at everything. Those $500 studies are very 35,000 foot view. It doesn't take into consideration all the nuances and the extra advantage. I mean, if a CPA can depreciate it, you know, a few items, and they're still leaving 50% of the money on the table, what do you think those $500 online services are missing? A lot.
Yeah, I mean, I would be concerned if I was doing it myself that I was missing a lot. Depending on, like you said, depending on the size of the opportunity potentially. And I think because your point about having a third party do this satisfies any kind of IRS audit for sure.
Exactly. Yeah, and we stand behind it. It's not, if you get audited, you're not going to have to worry about it. We've been in business 20 years. We have never had a study overturned or trigger an audit. So you can pretty well rest assured that you're in safe hands here, because if they do audit you, they have the right to stop you from taking the depreciation not only what you already took, but even going forward on that property. So the risk is high. So really taking advantage of the value here and the cash flow that's available to you starts with a cost segregation study if it's a fair, you just purchased the property, or if you've done a lot of repairs and you've owned this property for a while, more than 2 years, I'd say. Then we want to look at the tangible property regulations first on your depreciation schedule, because there's a lot of things that we could probably expense right up front. So the TPRs and bonus depreciation are based upon cost segregation. So tangible property regulations, this was instituted in 2014. It was the biggest change in the tax regulations in I think it's like 30 years, but they're not optional, it's mandatory. And if you do not do this, or your tax professional does not do it, and you get audited, what happens is they can deny you the right to expense anything going forward, or to depreciate it going forward, and deny what you've already taken. So it's very important that someone review what you've done on the property in the past, so that you can change it from capitalized to expense. And that takes somebody with an engineering background to look at this and say, okay, yes, this roof, no, we can expense this. We don't have to capitalize it, so that you can take it up front. And expensing it is a lot different than, depreciating it, because when you expense it, it's gone. Capitalizing it, you're carrying that on your depreciation schedule going forward. Okay, partial asset disposition is another thing that you need to consider. This is under tangible property regulations, those 2014 TPRs, also referred to as repair regulations. So PAD, partial asset disposition, is when you are actually going to remodel a building that you've owned for a year, at least a year. And I'm talking about a calendar year. So if you buy it in December and you do these renovations in January, we can still talk about it. But what happens here is that we can take it off your, we can actually take it off your depreciation schedule, the items in the building you're taking out. So let's say you buy an apartment complex and you're going to replace all the kitchens. Okay, those kitchens you paid for when you bought that building, but you're taking them out. So if we evaluate what it is you're taking out before you do it, then we can take those off your depreciation schedule because they're gone. Hopefully that makes sense to you.
So we can basically write off the cost of that old kitchen, in addition to accelerating the depreciation on the replacement kitchen.
That's right. But if you don't do this in the very first year that you make these renovations, you lose the opportunity to take off what you're removing.
Gotcha.
Okay, this is an example, a large example of how this really makes a difference. As you probably all know, whether it's a fast food restaurant or an automotive dealer, franchise type businesses, they are required to change things up for marketing purposes on a regular basis. Well, this auto dealership, their original building, because we did a partial asset disposition on this, what happened is the original building, what they took out, was worth $134,000 to them to be able to take it off their depreciation schedule because it's gone. The demolition, they could also remove $53,000. Renovation, $126,000 they got on that for cost segregation on the new improvements or the new changes to the property. So their total tax savings. Now I'm not talking about, just, what they're taking off. I'm talking about, bottom line, what they don't have to pay in taxes, $314,000. So here's another example of the tangible property regulations and how that applies, in that sometimes buildings, big commercial buildings, They can be purchased years ago. There's one 93, here's one 2000. This is the cost of these properties, but the improvements over the years allowed them tax savings, taxes they do not have to pay. $554,000 here, 1.1 million, almost as much as they paid for the property. So you can see when you're doing renovations, if you don't do this, it's really missed. You're leaving money on the table that should be in your bank account.
So go back to that slide. So even if we we bought a property a while ago, we did rehab a while ago, we can go back on that now and accelerate some items and get our accelerated depreciation now.
That's correct. That is correct.
What if we remodeled it twice?
We can go back because it's on your depreciation schedule. It's being depreciated. Those improvements, if they're capitalized items.
If they were capitalized at the time.
Right.
Yes. Okay.
And most of the time they will be if they're major improvements.
Okay.
They're going to be capitalized.
So
unless it's a $2,000 carpet change out, then you're going to expense that up
that
front.
would have been expensed anyway. But yeah, you're right. Okay. So
Okay.
you're going to go back and look at what was capitalized back in the day and see
Right.
if we can accelerate any of that. Okay.
Okay. Tax Cuts and Jobs Act. This gave even more benefits to you as an investor. So it gave you 100% bonus depreciation for properties built after September 27th, built or purchased after September 27th of 2017. Now, this now applies as of that the Tax Cuts and Jobs Act to new purchases, new construction, additions, or renovations. So the things must have a depreciable life of less than 20 years though. And that's exactly what cost segregation studies do, is they identify the specific 5, 7, and 15-year assets so that you can take advantage of this right now. Now, that doesn't mean that going forward, you won't have bonus depreciation. It's just going to change. The 100% bonus depreciation applies through 2022. 2023, it starts dropping. It's 80% thereafter, and it drops like 20% a year.
So if we got property that we bought after 2017 September, we need to do this now.
Yes.
Before next year.
Yes.
Right, too.
But also you want to do it in arrears, because the year before, let's say 2016 or up to that point, September 17, you also have bonus depreciation. It's just not 100%. The year before that, you're looking at 50%. So it's the year in which you purchased the property that we can do this for.
Okay.
So there's huge economic benefits to doing this. And here's a list of some of those. I want to mention the estate planning and trust, because I know that Brad and you do some of this, and maybe Jay too, working with people who are planning for their estates. If they pay taxes, if these trusts pay taxes, then they also have the ability to do a cost segregation. And even if they die that year, if they've done the cost segregation, there is no recapture. And the properties actually go to your beneficiaries at a step up in basis, which means they can turn around and do cost segregation again. And a lot of estate planners miss that. Also, commercial property owners, when you buy a retail building, as an example, you're buying everything that's in that building at the time. So if a tenant moves out, you can also go back and do what I called earlier the partial asset disposition, because you've got to take all that out for the new tenant, right? When you bought that property, you paid for that then. So it's there on your, we can put it on your depreciation schedule and accelerate it. So a lot of properties can qualify. Who can't use cost segregation? I get this question every once in a while. An entity, if you owe no taxes at all, don't pay taxes, you're a nonprofit, this isn't going to help you. If you are planning on selling that property within 2 years, it's probably not going to be worth your effort to do it.
Why would that be?
Because the cost of doing the study versus what you're getting in return, the ROI, though we have had people who will do it, it's not necessarily the best benefit for you. And you can see that if I do an estimate for you, you will see how it works going forward and when it starts making sense. So about 2 years really is what you want to look at.
Because it's going to take you 2 years to realize your tax benefit.
To start getting more benefits, yes.
I see what you're saying.
Okay.
I mean, yeah,
enough to justify going through this.
Unless you have just so much income in year one that you can use it all, you're going to
Yep.
probably end up using it in future years, partially.
Mhm.
Okay.
Mhm. And then we get into the recapture. You know, if you're going to have some recapture taxes, because well, like the partial asset disposition examples I gave you, like the automobile dealership and that thing, there is no recapture on disposed of property from those because it's removed from your basis.
Mhm.
Okay, 1250 property, the recapture is at 25%. So if you're taking this depreciation up front and accelerating, when you sell the property, you're going to have a recapture rate on the accelerated depreciation and ordinary depreciation as well. So it doesn't matter whether you're doing straight line or you're accelerating, you're still going to have to pay that recapture. The advantage is that with the time value of money, the recapture on sale, you're paying at lower dollar rates, and there are ways of mitigating that. Because you and I both know that that carpet in that building is not going to last more than 5 years. So it's going to be, you know, it's gone. The depreciated property is of less value when you sell the property or when you sell your building. And that can be a tax pros adjustment or CPA's adjustment to your taxes. Because they can justify, hey, this isn't worth what it was when he bought this property. So therefore, you know, it would change, you know, what you have to pay in the recapture rate. 5-year property that we identify is already fully depreciated at 5 years. So all of these things are things to keep in mind when someone says, oh, but what about recapture? No, it's time value of money. You want that money now. So to do a study for you, what I'm going to need
Jay, hang on 1 second. Did we have another question, Jay?
Sure. Yeah, we do. It's what this person, Michael, is asking, when is the study due? Such as, I purchased a warehouse this year. Do I need to get this done before December 31st or April 15th on the deadline?
It needs to be done before you file your taxes for this year.
So if you extend it to June or July or whatever, as long as you get it done before then.
Right, or even October if you're waiting till, you know, if it's a flow through entity, you know, it could be October of next year before you actually file your 2021s. Just give us enough time to get the study done. Because as we get closer to the tax filing dates, we get very, very busy.
You were just saying that right now before we started this, right? You're very busy right now doing that.
Yes, we are.
Well, for anyone that did not join early enough, her timeline is generally 6 to 8 weeks. Is that right, Bonnie?
That's right. Now I can make some exceptions, but don't push it. Okay.
Right.
I don't want to push an engineer that's already under stress.
Right.
You know, at this time of year, they get pretty busy. And then there's always the 3115s that CPAs hate doing. They break out in hives at the thought.
Right.
They're very complex. Usually takes an entire day to do one property's 3115. We do those for the CPAs and tax professionals. So there's no excuse. They can't say, well, I'd rather do a straight line depreciation because I don't want to do that 3115 form, which is a change of accounting because you're going from straight line to accelerated depreciation. So that's when they need that. Okay, and when I give you an estimate, it's going to be within 10% of what the actual is. So you can pretty well rest assured that what you've got in numbers is good. And ours is conservative because a lot of times people will use our numbers to mitigate having to pay for quarterlies going forward. And that helps too. So our process, I need a depreciation schedule if you've owned the property for, you know, more than a year, or you've already had a tax filing on it, or, you know, information about, you know, your purchase, the improvements, anything that you improved on the property. Then we give you a pre-analysis, and this is at no cost to you at all, no obligation. I don't arm twist. You either want the money or you don't want the money. And then, you know, we can, you know, start the engagement process, data collection. There are things that I'm going to need, and I will give you a list of what those are. And then we actually do an on-site visit of the property, and I don't care where it is, we do it. Okay. And then you get the final report and the 3115 if it's needed, if you've owned this property for a little while. So it's pretty straightforward. And I'm always open to questions at any time, you know, during the process. The Ways and Means Committee, as of September, has made some indications of what's going to be happening going forward. Capital gains most likely will go from 20 to 25%. Self-directed IRAs will no longer be able to be used for syndications, real estate syndications. And they're talking about giving you a 2-year timeline to get out of it. So they aren't even letting you go forward with something that you've already done, which was kind of interesting to me. And the federal income tax brackets going from 37 to 39, 39.6. 1031 exchanges, don't worry, there's no change to those. Inheritance, no change. Again, step up in basis applies. You can do cost segregation for somebody who's going to be willing this property to their heirs. And then the heirs could do it again when they inherit it at that step up basis. So the most important word in the world of money is cash flow. Second, leverage. And that's what we give you. So cost segregation usually will end up giving you 6 to 10% of what you pay for that property in upfront after-tax cash flow. So you buy $1 million building, you can usually count on $60,000 to $100,000 in after-tax cash. And I've had brokers tell me, hey, I sent you to my client, he's got $90,000. He turned to me and said, find me another property.
Mm-hmm.
So why leave this money out there? Okay, it's yours, use it. So any questions that we haven't answered?
Yeah, looks like we got a couple, or at least one coming. Helston had another one, looks like.
Yeah, no, I think we're good on that. I mean, what I see, Bonnie, as a real advantage to this is oftentimes people are on the multifamily side are buying some of these value add properties that there's a lot of upfront CapEx, capital expenditures in the beginning. And this is a great, your first few slides that showed the spike and accelerated recapture, or whatever you call that, is very helpful because people are going to be sitting without a whole lot of cash flow as they're rehabbing these properties.
That's right.
So
that's right.
That's where kind of the light bulb went out for me.
So you get some of your money back.
Yeah, and the other thing is by timing it right, you know, let's say you buy the property and it's habitable, it's rented, whatever, in 2021, don't necessarily do everything to the property this year. If you can put it off and do that rehab the next year, then we have what I had mentioned earlier, that partial asset disposition will save you more in taxes the next year. And I know this gets a little complicated, gets more complicated when I'm talking to CPAs, but you know, if you have questions, something's foggy, don't hesitate, give me a call, drop me an email, be happy to explain it. Our consulting is free of charge because we want you to make the best cash flow decision for your situation.
Excellent.
Yeah.
Any other questions from anybody?
I don't see anything at the moment. Bonnie, what's typically the turnaround time if somebody sends you a property and they want to get just kind of a general assessment on costs?
A day or two.
Okay.
Yep. If I have, they give me the information I need to get it in. Usually a day or two is typical. As we get closer to tax time, it might be out 3 days, but rarely is it that long.
Sure. Amy's asking, what's the average cost for the full assessment? But obviously that would depend on the building size and what needs to be done, correct?
It's an excellent question because that's a common, what's it going to cost me? Well, if you're looking at a warehouse, which is typically 20% office build out and 80% is open warehouse, there's not a lot to depreciate in that open warehouse. Most of the money is going to come from the build out. So if you have the same square footage and you have a multifamily property, obviously there is a lot of build out in that multifamily property.
Mm-hmm.
And the more build out there is, obviously it's going to take more engineering and construction, separating that stuff out. So the cost of doing an office building or a multifamily property is going to be higher than the same square footage in a warehouse.
So when you do your initial assessment for somebody, if I were to come to you and say, hey, Bonnie, I've got 5 properties here. They're all in the $750,000 range each. And I want you to do a cost seg, or at least an initial assessment to tell me A, what it would cost, and B, maybe what you think I might be able to get back. Is that how you do it?
Yes.
So I can assess, oh, is it worth doing for me?
Yes, both. I mean, you
Yeah.
can take a look at it and decide then, okay, this is what it's going to cost me to do. It's 50% up front, 50% when the study's finished. And you can look at the numbers and say, yeah, I think this is going to help me. Or you can say, no, I don't think I'll do it this year. I'll do it next year.
Right. Well, the numbers you're showing me, I'm thinking, well, hell yeah.
The sooner the better, usually.
Right. I'm also thinking it's a great idea to go start buying a property in the 4th quarter of the year and then doing the renovations the next year,
You got it.
getting that going too. So,
Mhm. It's about tax strategy. And,
right,
your tax professional, that's not their job.
right.
It's very few of them that are going to be giving you tax strategy. So when you're investing in commercial properties, this is the kind of information that you need to make good decisions going forward.
And I know my CPA isn't savvy enough for this.
Most aren't.
Yeah.
When I do CPE classes for a firm that might have 10 CPAs,
Mhm.
I find that maybe 1 out of that 10 has ever, really worked with clients on cost segregation studies.
Right.
Wow. That's surprising, actually.
Yes.
Right.
Well, you can also look at it another way. I mean, we've done 30,000 studies, more than 30,000 at this point, in the 20 years we've been in business. Every year in the United States, there are over 60,000 properties, commercial properties that change hands.
Oh, yeah.
So that's how much money is being left on the table, because this stuff is not easy for even the CPAs to understand. The tangible property regulations take 300 to 400 hours of study to really understand them thoroughly.
Yeah.
There's 5,000 pages in that document, IRS document alone. So, most tax professionals are, commercial properties are not necessarily their total practice. And so are they going to spend that much time and effort learning one particular niche? Not likely.
Probably not. They got a lot of clients. They have a lot going on. So yeah.
So that's why we're here. We help make their jobs easy.
Excellent. Well, I appreciate that. And I guess unless we have any other questions, we'll wrap it up. I appreciate everybody joining. Thank you very much,
Yes.
Bonnie, for
Thank
presenting
you.
today.
You're
And if
welcome.
anybody has any need or questions, feel free to reach out to Bonnie directly. You can also call us if you're thinking of buying or selling a property before the end of the year. We're happy to help you with that as well. Jay, anything to add?
Okay.
Yep.
Okay.
We're all good.
Thank you. Take care, guys.
Thank you, everyone.
Thank you. Have a good day. Bye-bye.